A few years back, there was a lot of talk about a potential market crash. People were really worried about it. Nowadays, the conversation has shifted to predictions of a soft landing and doubts about a recession. However, there's an important aspect many seem to overlook, a principle that suggests only the cautious survive. When examining the market, it appears to be thriving, nearly reaching record highs. But if you remove the top 7 stocks from the equation, the overall picture changes dramatically. Additionally, there is a specific indicator that signals when a recession might actually begin, and it's not during the period when interest rates are climbing. It's after we stop increasing rates that we should be more alert. Let's talk about the history of interest rate hikes in the United States. Historically, the pace and scale of recent rate increases are unprecedented. For example, from 2015 to 2018, rates went up by 2 percentage points. Between 1999 and 2000, the increase was 1.51 points. However, none of these compare to the sharp rise of 4.88 percentage points we saw from 2022 to 2023. The Federal Reserve's balance sheet provides insights into their bond-buying activities. Meanwhile, the M2 money supply indicates the amount of money circulating in the economy. There was a steady increase until 2020, followed by a sudden surge as the economy was flooded with trillions of dollars, a scenario we haven't encountered before. With all this data, it's challenging to confidently predict the market's future, especially without a similar historical situation to reference. This uncertainty underlines the importance of being cautious and not overly confident in the face of potential economic shifts. Gold has consistently been a crucial part of many successful investors' portfolio. It's an asset that they can rely on in various situations. Here are some key points about gold. Its market capitalization is around $11.8 trillion. Since the year 2000, gold has seen an average annual growth rate of 9.24%. During periods of high inflation, this rate has increased to 15.35%. Including gold in your portfolio offers several benefits. It's a hedge against inflation and a safeguard against potential risks associated with central bank digital currencies, CBDCs. Gold is a unique asset that cannot be duplicated, providing a layer of security against the possible manipulation of digital currencies. In the event of a cyber threat where access to digital finances can be compromised, physical gold remains accessible. Moreover, gold offers privacy and contributes to the diversification of your investments. As for the future, especially the year 2024, opinions vary widely on whether a recession is imminent. Surveys show differing perspectives. The Federal Reserve staff predicts no recession, while the yield curve suggests a 61% chance. Economists, consumers, and various financial institutions also offer varying predictions. Interestingly, a significant 84% of CEOs anticipate a recession, possibly because they have insights into their company's financial situations that others might not. When analyzing the language used by S&P 500 companies during earnings calls, there's a noticeable shift. References to inflation, material costs, economic slowdowns, and job cuts have all evolved over time, providing insights into the broader economic landscape and company sentiments. While no one can predict the future with absolute certainty, especially in unprecedented times, it's wise to consider diverse viewpoints and include stable assets like gold in your investment strategy for added security and balance. Could the current state of the market be a sign that everything is all right? Well, despite this possibility, it's intriguing to note that 84% of CEOs predict an impending recession. What unique insights do these executives have that might not be evident to others? In the realm of the S&P 500, which consists of America's 500 largest companies, a peculiar trend is emerging. Just 7 of these companies constitute 28% of the entire index's value, an unprecedented concentration in the history of the S&P 500. These dominant players include major firms like Meta, Facebook, Nvidia, Apple, Microsoft, Alphabet, Google, Amazon, and Tesla. This dominance is significant when examining the performance of the S&P 500. While the index shows a return of around 12.4% for the year, the combined return for these 7 companies is a staggering 92%. If these 7 are excluded, the performance of the remaining 493 companies shows a decline, indicating that a small group is disproportionately influencing the overall market health. Further analysis into different company sizes reveals more about the market dynamics. Comparing the S&P 500 large-cap companies, Russell 2000 small to mid-cap companies, and a micro-cap ETF sheds light on how different segments are performing. The S&P 500 shows an 18.66% increase, highlighting that larger companies continue to grow and strengthen. In contrast, the Russell 2000 has only a 7% increase, and microcap companies are experiencing a decline of 1.85%. This disparity suggests that larger companies might be better equipped to navigate current market conditions, possibly due to their substantial resources and capital. However, the overall market's apparent health, buoyed by the success of a few large companies, might not provide a full picture, especially considering the struggles faced by smaller companies. It's crucial not to be misled into thinking the entire market is thriving just because a handful of companies are performing exceptionally well. The market hasn't plummeted yet for a few key reasons. Firstly, the Magnificent Seven companies are propping up for the S&P 500, creating an illusion of stability. Second, unemployment is a 50-year low, which means most people have jobs and can manage their finances without immediate panic, mitigating widespread fear of a downturn. However, there's a concerning trend relating to U.S. consumer credit card debt, which has surpassed $1 trillion. While credit card use isn't new, the rising debt level is unprecedented in American history. What's more alarming is the surging credit card interest rates, which are at their highest. As these rates climb, so do the monthly payments for consumers. If someone is used to paying $300 monthly and suddenly the amount jumps up to $420 or more, financial strain becomes inevitable. Adding to the concern is the resumption of student loan payments post-COVID-19 deferral, affecting 30 to 40 million Americans. Imagine the additional financial burdens as these individuals start paying around $300 more each month. On another note, let's talk about mortgage rates. They've significantly increased, currently exceeding 7% and in some instances reaching 8%. This is a sharp rise from the lows of around 3% seen in early 2022. Despite this increase, some argue it might not lead to a market crash. The argument hinges on the idea that while higher mortgage rates pose challenges, they're also a site of attempts to stabilize the economy and could prevent overheating in the housing market. The average mortgage rate across all loans hasn't significantly increased because the spike in rates primarily affects new homebuyers, not those who are refinancing. The refinancing market has slowed considerably since existing homeowners are hesitant to switch from low-interest loans to the current higher rates. This reluctance to sell and buy under new higher rates explains why the overall average mortgage rate hasn't risen sharply. On another topic, let's consider the impact of Federal Reserve's interest rates hikes. Historical data suggests a delay between the end of rate hikes and the onset of a recession. This lag time is varied, but averages around 11 months based on past occurrences. If this pattern holds and considering hypothetical future rate hikes, one could predict the potential timing of the next recession. Corporate financial strategies also play a role in the current economic landscape. During periods of low interest rates, companies have borrowed large sums of money cheaply, often investing in bonds that offer higher returns. This approach works well until the loans mature or interest rates rise, at which point companies face increased repayment costs, potentially leading to financial distress. An example is WeWork, which despite significant investment faced financial challenges, highlighting how the changing interest rates environment can impact companies. This situation illustrates a broader risk where companies that have benefited from low borrowing costs might soon encounter difficulties as conditions change. Let's break down this issue with corporate debt in simpler terms. There's this chart showing how much money big companies owe and when they need to pay it back. By the end of 2023, these companies need to pay back about $220 to $230 billion. But in 2024, they'll need to pay back even more, around $790 billion. This amount keeps growing each year, reaching over $1 trillion by 2025. The rising debt is one reason why many company bosses are worried about a recession, with 84% of them thinking it might happen soon. They're nervous because they see these huge bills coming due and wonder how they'll manage to pay them. Regular people are feeling the squeeze too. With credit card debt at an all-time high and student loan payments restarting, many are finding it hard to keep up. Plus, we're seeing more people unable to pay their debts, whether it's on their homes, cars, or other loans. Now, let's talk about the U.S. government, which owes a lot of money, about $33 trillion. When interest rates go up, the cost of this debt goes up too. For every 1% increase in interest rates, the government has to pay an extra $320 billion. If rates go up to 3%, that's an extra $1 trillion the government needs to find. Looking back from 1970 to now, the cost of the government's debt has been rising, but it shot up dramatically after the COVID-19 pandemic. The big question is how the government will handle these growing costs, and it's likely that they'll need more money from taxpayers to help cover it. While it's good to stay positive about the future, it's also important to understand these financial challenges. They could affect big companies, small businesses, and everyday people like us in the next few years. Here's a simpler breakdown of a chart about the United States finances. The chart shows four things: tax revenue in green, which is the money the government gets from us each year; GDP in orange, which is the value of everything produced in the country; interest payments in blue, which is the money the government pays just for borrowing; and the national debt in red, which is all the money the government owns. Back in 1980, all these numbers were close together, but over 43 years, the debt, red, skyrocketed while GDP grew steadily. Now, the interest payments are becoming a huge expense, second only to the GDP. This shows that the government is spending more than it's managing well, which isn't great news. You might be wondering, what does this mean for me? Should I be worried or stop spending money? It's not about panicking, but being smart and aware. Think of it like a game of Monopoly. If you play too safe, you might not grow much, but if you take calculated risks, you could end up doing well. The story with the Monopoly game is a way to show that being too cautious or too reckless can both have downsides. The winner was the one who found a balance, took some risks, but also knew when to hold back. So what should you do with your money? It's not about spending it all or locking it away. It's about understanding your own comfort with risks. If you're okay with taking some chances, now might be a good time to look for opportunities, especially when others are scared. But always remember, no one can predict the future perfectly, not even experts. Just stay informed, prepared, and don't get swayed by people who say they know exactly what's going to happen. Understanding the market and why it hasn't crashed yet is like piecing together a puzzle. Just like deciding whether to buy a new home or dive into real estate as a business. It's all about knowing what suits you best. Are you ready to weather the ups and downs of the market, or would you prefer a safer, more stable path? It's a big decision, just like choosing between a long-term home or a new business venture in real estate. What are your thoughts on this? Do you feel the market will hold steady, or are there surprises ahead? Share your opinions in the comments below. And don't forget, if you have any questions or there's something you want to learn about more, just let us know. Remember to hit the subscribe button to stay updated with our latest insights. We got plenty more interesting discussions coming your way soon.